And African Bank reporting a 26% drop in first half headline earnings per share. That's to 126 cents. ABIL has declared an ordinary dividend of 25 cents. Now, the shares plunged today as much as 26%. In fact, they have since recovered somewhat, still trading around 14% in the red. And this, of course, is sparking fears about ballooning, sparked by fears of ballooning bad debts in the unsecured lending sector. Now, earlier I spoke to CEO Leon Kirkinis about how many loans they plan to rehabilitate.
Historically, we effectively 40% of those customers tend to be, we tend to rehabilitate in cash. Well, if you look at it, we collect about between 60 and 50% in cash, but then to get to the provisions, you end up discounting it based on your inherent interest rate. So your present value of that cash flow represents around 40%, and therefore you have 60% provisions.
Advances still up 25% during the period to 59 billion rand. So give us an idea of the nature of the loans that are now going out from ABIL.
The reason the advances are growing at 25%, even though the sales new loans granted was down in this period, is because the average loan size coming onto the books is bigger, and the average loan term coming onto the books is bigger than the average loan size and average term coming off. Now that will actually slow down. So even for this remaining period of this year, we are indicating between 18 and 22% growth in advances versus the 23% we indicated previously.
And just looking on the insurance side, because that is a big generator in terms of income, but you've also got claims paid doubling to around 800 million rand. So is this going to be repeated? I mean, what is the kind of outlook for that part of the business?
The claims paid is actually at the moment a provision that we've raised for benefits that we're going to offer retrospectively to our customers. So the retrospective, or the increase in the retrospective nature will not continue into the second half. But we're certainly looking for more and more benefits for our customers to help them rehabilitate themselves through the provision of our insurance cover. And we are looking constantly for ways to do that. That ultimately becomes a trade-off between the bad debt and the insurance claims line. But initially, it's actually additive.
So you've mentioned, of course, the second half might even be slightly worse when it comes to bad debt. So when are things going to get better? Do you have any visibility with that?
Yeah, we do. I mean, I think that it typically takes about 8 or 9 months for your peak risk to emerge from when you put the loans on your books. And this really relates to sort of business that we were writing in the first half of last year. And we started to slow down from that period on. So it will wash its way through the system through the course of this year and the early part of next year.
And on the funding mix side, I mean, you've got 2.7 million customers. How many of those are actually depositors of yours now? How's that strategy been panning out?
We haven't yet rolled out our deposit strategy to our customers. It's more to a select retail base of high net worth individuals rather than our customers. So we've been concentrating with our customers more on credit and insurance than we have on savings.
And overall, also revenue enhancing initiatives is what you talk about. So what does that mean? Is it looking at specific products you have right now and growing that, or looking at a new portfolio of products outside of your traditional product offering?
We're continually looking and rolling out products into a market that both at the traditional place as well as with in new markets. Like, for example, we're expanding into the foreigners living in South Africa. That's a pilot we're running. We're continuing with a pilot into our vehicle finance market. We're continuing to learn how to do things in Ellerines. So we're always looking at opportunities, and as a result, the returns that we generate should and will improve from here.
And just let's talk about Ellerines and where it's going to fit into the ABIL group going forward, because HEPS there falling back to 18 million rand from 191 million rand. So does it still make sense to have the furniture retailer in the group?
I think that the marketplace that we serve through Ellerines is more has less income, is more rurally based, so it's somewhat different to the marketplace in the bank, and we haven't yet really managed to completely deal with that marketplace sufficiently well so that we can control the risks and keep them in a place where we'd like them to be. So it's a learning process for us, and it is a smaller part of our portfolio, but it's critical that we learn how to do that.
So looking at what you're doing now at the bank, is it going to be a focus on more diversity?
Yeah, I think diversifying risk is key. We've got 2.7 million customers spread across all sorts of sectors. So, and in risk, ensuring that you have a diverse customer base that you're dealing with is important. We remain a business that's very focused on unsecured lending and helping people live their lives through the provision of credit. And that's core to who we are and will continue to be. So you're not going to see us diversifying into different, like outside of South Africa, or into substantially different products than we presently offer. It will be within the credit environments, and particularly also of late the insurance environment.
Mm-hmm. I mean, if you look at the stock today, and it's not a good day to look at the stock, it's down around 25% when I last checked. It almost seems a bit of panic selling in the market, and there have, of course, been a lot of comments around, yes, well, moving to even further value territory. So how do you say to shareholders, stick around because things will get better? I mean, what's the message to the market?
Yeah, I think, we always feel the pain for shareholders when suddenly you see the, share prices fall. One's got to build a business and manage a business over the long term, and the share price will reflect that in the long term. I think the message is, even though we're having a challenging time, we still generated a return on tangible equity of 25% or 24% in this period. So, that just shows how robust the business is. And sometimes people can lose sight of those key underlying